You know, while there's always hand-wringing about the employment report, Wall Street looks at certain elements, while the media and politicians also craft their own take on it, typically through ideological lens. For everyone else, though, this report, particularly this morning, I think, sheds a light, even hope, on the current situation and trends. I mean, for me, the biggest takeaway is the greatest swath of this nation getting a piece of the action. You know, I think those so-called new-collar jobs are breathing life. I mean, life and fresh opportunity for many who had given up. I mean, consider last month, the unemployment rate, it plunged for those with less than a high school education. It was even better for those with only a high school diploma. In fact, the unemployment rate for high school grads now at the lowest level since 2000. And when the U.S. economy peaked at its largest percentage global GDP, there were great jobs, right, for everybody who worked with their hands. Not everyone needed a college degree. Well, that's happening again. Lower-skilled workers aren't trapped in low-paying industries anymore. I mean, consider the weekly pay of the two lowest-paying industries, retail and leisure. We're talking $588 or $420 a week. They saw jobs decline to $33,000 last month from $47,000 November of 2016. But the warehousing jobs, right, they pay $812 a week. They surged 100% year over year, over $25,000. You know, the country is moving in the right direction, and more people are coming along for the ride. And for me, that is great news for everyone. Turning right now back to our panel, and let's find out what we can do for the viewers. We brought Jeff back and Ken. Jeff, okay, you talked about getting into more cash. I think everyone's in more cash right now. But our viewers aren't going to go 100% cash,
no,
right?
Of course not.
What do they do? Because up until about a week ago, most questions people are asking me is, where's the bottom and what do I buy?
I'm buying midstream master limited partnerships. They're the cheapest they've been in 20 years. Most of them have already reduced their distributions, not because they had to, but they wanted to get their leverage ratios down. And
MLPs were easy money for a long time. Then they imploded.
The upstreams.
The upstreams. What's the relationship to price of crude oil? How much does that impact these?
The midstreams have very little price sensitivity to crude oil because you can think of them as a transportation company without wheels. They own the pipes and the storage, and they have long-term contracts with Exxon, Chevron, people like that.
Ken?
I think we have to make our own returns. We don't become day traders for our clients, but at the same token, buy and hold, like 2017, we got a little bit spoiled. I mean, the biggest drawdown in 2017 was 3.5%. So when we have these awful dips and it feels nauseating like you want to sell, you know, step to the plate a little, buy some XLK we like. That's an ETF for technology, maybe BST.
So you still like technology here?
Yeah, we do. Look, we came into tech. Look, right now, utilities leading, so that's a problem, obviously. But again, we look at banks. They're not going to be our leaders. I think coming into this mess before October 3rd, technology led. I think when we finally get our footing here, technology will lead again.
Fundamentals, do they matter in this kind of environment? I mean, we know when everything's getting hit, everything gets hit.
Yeah, that's a fact. And selling begets more selling, especially with the machines taking control of the thing. But eventually, wiser minds like Ron Barron at Barron Capital will prove to be right with the buy and hold strategy. And he's a great value investor, and his average holding period is 10 years.
But there are times when you have to make some changes, right? I mean, there are some times you say, hey, listen, this was a dud. You know, I got to get the duds out so I can find the better names to hold. And that's a difficult thing for people, in part because of pride and ego, and in part because people aren't sure how to do that.
I think that comes down to self-discipline. All of us know when to buy something. Our Uncle Joe tells us something to buy. Maybe one of your programs, a magazine. We know how to buy things. We don't know how to sell things. So the self-discipline, maybe use a stop-loss order. Maybe sell a call against it. Again, it's a little bit different, but for most individual investors, they know how to buy something. They still know when to sell it. For us, we rather use a stop-loss order, and you can be wrong, be down 5-7%. It's not going to eat your capital up that way.
Stop-loss, what's your typical, is there a certain percentage you use most of the time?
Sometimes we don't use the whole position for stop-loss because you can get washed out in the morning and then run the market back up.
That's what I mean.
Again.
It's pretty knee-jerk. I mean, it's 5%, 10%.
Yeah, well, usually 5 to 7% in that range there. But at least some type of self-discipline or some conversation with the client about a self-discipline. Like I said, it's very easy to buy something, but when do you sell it? And if the stock goes higher, a trailing stop-loss order along with it.
Even if we're in a bear market, it doesn't mean there won't be rallies to the upside within that bear market, right? So, you know, even during the Great Recession, Great Depression, there were like a number of bear market rallies.
Right.
How do people handle that? Do they try to play that game, Jeff?
Traders do. Investors don't.
Okay. So investors, for the most part, the husband and wife watching the show, you know, she's a police officer, he's a school teacher. They've got about $150,000 income a year. and they want to put their kids through college. They're both about 40 years old. How do they handle this?
Find an equity income fund that's fairly conservative and dollar cost average in it every month.
Just keep buying.
Yep.
Because this way you'll definitely hit the lows.
Yeah.
You'll definitely buy the bottom at some point.
Yeah. 529 plans, especially those age-based ones where the younger the child is, the more equity exposure they have.
Right.
As they get older, less equity exposure. So 529 plans.
I've always been accused of being a rose-colored glasses guy. We only got 20 seconds, and maybe I'm too sanguine. Are you afraid right now,
No.
Jeff?
No, these are opportunities. That's what we look for as investors, right?
Yeah, but I mean, you're not afraid, though, that this market is telling us something more dramatic, more drastic is
We don't
around
see a
the
black
corner.
swan here at this point.
I agree.
All right, guys. I'm not the only one. Rose-colored glasses for all. It's a pleasure. Thank you both very much.